Let's talk about stops today. Where do you put your stop in order to stay in the trend as long as it's running in a smooth trend? How do you get out of a trend early enough if it's not a good trend, if it keeps pulling back and not eventually ending up being a market phase where you actually can make money? If you look back couple of hours, couple of days, couple of weeks, depending on your trading time frame, and you see a trend and you haven't participated in it, then something is wrong with your system rules, with your stops. You want to stay in a trend that runs. It doesn't really matter if it's smooth. A smooth trend is of course the best trend that you can get if it still comes back again and again, but the general tendency is the upwards tendency. Then you should stay in that trend. And how do you stay in that trend? And if it's not a trend, how do you get out soon enough so you don't give back too much of your profits? Now, the first rule is that after your breakout, after your fractal breakout, maybe depending on what kind of breakout you're trading, you're getting into the market and it moves up. And of course, this is a little bit of a difficult example here, this weekly gold chart, since we're doing hindsight trading, hindsight stop putting, and this is also always pretty easy to do. Very different conditions you will face if you are in a live market. However, you need some rules, and you need to look at these rules. You need to look at some examples and backtest these rules. This is the only way how you can find your way to navigate in the live market. So let's take a look at this gold chart. Maybe it helps a little bit to navigate for your next trades in live markets. So let's say this fractal has been taken, you are long in this market, and now the price has been moving up. Where do you get out as the market is coming back from its up move? Very easily, you could simply get out as soon as the price closes inside of the balance zone. That seems to make sense, since the balance zone is the place where the market wants to be. If it stays in the balance zone, what it's telling you is that there is no trend. So as soon as it's closing inside of it, you could get out. That would be one way to do it. Here you have your candle after your fractal entry down here that closes inside of the balance zone. You could simply get out there. Another way to do it is to add a moving average, a simple moving average. Depending on your liking, you could enter a 9 or a 10 period moving average. You could also add a 5 period moving average with an offset of 3, so you have a displacement into the future of 3. What this does is it makes it a little bit smoother, even in accordance to the balance zone, and it will get you out a little bit better than a usual moving average, even though the difference won't be too big. In the end, I haven't tested it compared to a usual moving average, but the smooth moving average seems to adapt a little bit better to the current price movement. So as you can see in this chart, you would be long from the fractal and you're out right here. That would be your stop, a close below this moving average, this blue moving average that I just added. And that would have been just a little bit of a better exit, as if you would have been stopped out inside of the balance zone. This is of course only true that on your entry you will place your stop below the last fractal or below the last significant dip or support level in a internal sideways movement. This is your fractal here. A fractal is of course always 2 bars to the left, the highest one in the middle, and 2 lower ones on the right. Your stop could have been just below this bar here. If you really wanted to make sure that you didn't get stopped out, you would have put your stop below that fractal here. That's your initial stop, always on the other side of the balance zone where the fractal is located. And then the price starts going. Where do you get out? You get out inside of the balance zone, or just like here, or just below this blue moving average. If you want to stay in a market longer, if you kind of are trading the longer time frames and you want to stay in, you want to really follow that thing until it finally comes or is undone and drops into the balance zone and even below the balance zone, with the indicators showing you divergences and then moving below the zero line in an uptrend. If you want to do that, you would be waiting for a fractal inside of the balance zone. This requires a little bit of trust, because sometimes it happens that prices don't give you that fractal inside of the balance zone. They will give it to you outside of it, and this is very late, or can be very late. You're very close back to your entry level, and this will not be the greatest profit, but for the trends that are really moving, this is the way to place your stop. Wait for the fractal inside of the balance zone. If it's created, you put your stop below it and then wait for prices to keep on moving higher. At some point you will simply be stopped out using this method. Otherwise, you're giving the market enough room to move. Remember what the fractals really are. They show you where the price has decided, or not the price itself, because the price is simply made up of very, very different kinds of people thinking very different kinds of things. You will always have buyers and you will always have sellers in the market, but the fractals show you where the market changed its mind. It wanted to go up, but then it decided to take a break and go down. This is what you can see in this move. It goes up, straight up for 3 weeks, and then it takes a break here with these two candles. It's not a whole lot of a break, but the fractal here shows you that the market is kind of slowing down. It's entering some sort of correction. If you look at the daily chart in this moment, you will see that these 2 weeks give you some sort of correction that could go into the balance zone, even as far as the blue line, which would be this here on the weekly, and this is hit or could be hit in such a market movement here, or even such a market movement here on the daily chart in such a period of time. This essentially means that you want to try and stick with the trend as long as it is running, and you can make use of these very important decision changing levels. And of course, what I just explained also accounts for the downwards fractals. The market takes a break, it decides to stop its downward movement and go up again. The next up fractal is actually broken at this point even. So you want to use these kind of fractal areas to determine where your stop could be, in order to give the market enough room, but not too much room, right? So let's take a look at which fractals work. And then now I'm coming back a little bit to what I've said the last time. In your chart you will see just fractal markers. However, not every fractal is the same. It doesn't have the same meaning. And now we are actually talking a little bit about market structure. A lot of the times when you see people talking about basic market structure, they will show you, let me draw something here for you. They will show you a movement of the market just like this. You have 1, 2, 3, 4, 5 going up, and you have 1, 2, and 3 going down, and after this is done, you have 1, 2, 3, 4, and 5 going up again. So essentially what they are saying is that every market is in an uptrend all the time. That's of course not true. Remember that areas like this, for example, or even areas like this, or areas like this here, they can take a lot of time. They can take 3 weeks. they can take 3 years, they can take 30 years. Gold has been in a correction for over 20 years, sometime during the 80s and during the early 90s. The market can be caught up in a correction or in a trend for a very, very long time. You will find stocks that have been trending up since the 1960s, and they are in such a phase here. This is basic market structure, and every market moves like this, and you will find these kind of fives that are going up and threes that are going down, but it doesn't mean that you will find it on every time frame all the time. The market can be caught up in some sort of these market phases. So that's pretty much the point here. The kind of picture that I just showed you is what you generally find. In my opinion, the market does move like that, but there are some more details that you should pay attention to. In my opinion, you get a 1, you get a 2, you get a 3, and inside of that 3 you already get a correction, and then you have your 3. This is actually all your this is all of your third move there. Then you get a kind of a fourth move, which of course is a correction, and then this one will go higher, and at that point you have your first sort of up leg continued, and you can expect a bigger type of a correction. And once this is done, and at this point you will actually see a divergence in here, what you will get is a longer type of 3-wave correction to the downside. And now pay very careful attention that this down move, before it continues up and makes new highs above the old high, will actually go lower than here, and it will go lower than here. These areas will be fractals, or will show you fractals on your trading time frame. Depending on where this is unfolding, you might not get a fractal at this point on the weekly, but you may actually get one on the daily, and you get one on the daily here, and you get one on the weekly as well. And then, of course, after this has been finished, even though it looks like the market is coming down quite heavily, you will get a fractal at that point as well before the market resumes its up move. Therefore, these two fractals, this one and this one, are not good places for your stop, because this area here will take out these two fractals, because they are simple internal corrections. This whole movement from this area, from this point here, all the way to this point here, is not corrected until this correction has happened. These corrections, this one and this one, simply care about or are correcting the up moves from point A here to point B over here. So you need, after this is done, all of this is done, you need a correction for the move from A to B. And this will be finished by this type of downwards movement. And these fractals here, the internal corrections, they will be taken out before the market, of course, can make a higher the next high. Now, if we take a look at gold here, this is exactly what we see. You have, and we don't count waves. Please remember that. We don't want to count waves. We just want to have a look at the basic market structure, take a look at the momentum, and distinguish internal corrections or minor corrections from major corrections. And in the major corrections, or with major corrections, as I told you before, the oscillator will see the area below the 0 line in an uptrend. Now you have taken this fractal here to buy. You are long from here. You bought it, and now you get this fractal right here. But this fractal is not inside of the balance zone, as you can see. And if you take a look at the market movement here, what you really have is a point A breakout, and you get a movement to all the way to point B, where this fractal is occurring here. And what you see in this zone is simply an internal correction. And this is the second one that I just showed you in this little drawing here, and this is the first one. You don't have a fractal in this area, but you do have one in that area. So no fractal here, but you do have one here. So this would kind of make you think that this area is more significant than this one. But since they are both internal corrections, and we also don't have an AO that is going below the 0 line, it's simply losing a little bit of momentum. The difference between them is pretty much 0. The only reason that you get a fractal at this area and not at that point here is that this correction took longer than this one. And that should become clear if or when we go to the daily chart. Let me take a look really quick here. This is actually what we are looking at. The internal correction can be seen here. On the daily you do get a fractal, but not on the weekly. And this is the major, also an internal correction, but on this chart, the major correction, where this area is the fractal on the weekly chart. Again, these are internal corrections. If you trade the weekly chart, which is the subject of our analysis here, we don't really care about the daily chart, and we don't care about this being the major correction. All we care about is that on the weekly we only have internal corrections. On the daily we have one internal correction and one major correction. The major correction then again will probably end somewhere in the area of the previous internal correction. However, since the daily involves a lot of noise, it's not as clear, or the price movements will involve a lot of noise, and the action will not be following the theory, if you want, or the rules, if you want, as clearly. Again, on the weekly chart, this is not a fractal but an internal correction. This is a fractal and also an internal correction. Once we are at this point, we want to know, as soon as we see that prices are moving down, where should we place our stop in order not to be stopped out and survive the major correction, or the correction after the movement from point A to point B has been done, because of our 1, 2, 3, 4, and 5, which is 1, 2, 3, 4, and 5. Again, we are not counting waves. We are only following basic market structure. We want to know where we can put our stop in order to not be stopped out at this area. And this place here is not a good point because we are stopped out. So what I usually do is I take a look at all of the internal corrections that happened before the market reaches point B. Since you don't know when this point B will occur, how do you know that point B occurs here and not here already? It doesn't really matter if you know or you don't know. All you have to do is identify these internal corrections on your trading time frame, then go one time frame lower to the daily, find the area where these occur, and take the low of these two type of corrections. So you have two internal corrections, number two, and this is number one. Sorry, from left to right, number one, number two, and one is lower than two. So this is where your stop is. If two was lower than one, then that's where your stop would be, to stay in the trend on your trading time frame, which is actually one time frame higher. So this would essentially mean that in gold your stop is here, which means that you're not stopped out in here. No, the market actually started to work its magic, and it gave you this fractal that you see here right on top of this area where your stop was sitting. Because of this market structure here, the market will always come back to these previous internal correction levels. And the point is that if you really want to pin it down, then what you're looking for is not a fractal level, an exact price of a fractal where it's located, but what you're looking at is the area of fractals. So in between here, now that looks really crappy, I'm sorry. Let me give that another try. You have a fractal internally at this point, and you have a fractal here. These both of these internal corrections, okay? And what you will do is you will look at the area between them. And this is probably the most likely area where price finds the support and then zooms up if you have an overall uptrend. And in order to determine that, of course, you will have to look one time frame higher. So that would be the monthly chart if you're trading on the weekly. So in this case, it means this is your entry, you've entered, the market gives you internal corrections at this point, maybe at this candle here, you're asking yourself, market is not going up anymore, I'm long, where should I get out? Where should my stop be? And then you would say, if you want to know where your stop has to or needs to be, you would look at the internal corrections that happened before it. In this case, it's two internal corrections. Could be only one, could be three, could be four. Nobody knows. It just moves, and as soon as it starts to approach the balance zone, you would be looking to where the best place is for your stop. And that would be between or somewhere in the area of the last two internal corrections, or three or four. And of course the stop is just below that, okay? Don't want to put it too tight. And then you have your fractal created in here, and market zooms up. If you trade the weekly, what this means is you're in this trade for like, if this really keeps on moving, you're in this trade for probably a year and a half. So not everybody is ready to do that. So you want to make sure that you know what you're trading. If you're trading the balance zone stop, you're out sooner. If you're trading the SMA stop, you're out sooner as well. That is just your choice. Of course, this is a hindsight example, just as I said, but maybe it helps you to kind of get clearer on where your stop should be. Don't try to do anything by feeling where the market could go. All of these lines, the green line here, the red line, as well as the blue line, could all be targets in such an up move, and you don't want to just gamble and say, oh, it's probably the red line. No, you want to look at these areas, and then the market tells you where the stop should be, and if it's the green or the red or the blue line. Okay, now I don't know how much you know about trading and how much you know about different strategies, but these areas will show you supply and demand levels. Apparently, this is what the institutions are trading. I don't know about that. I just want to follow the market. But if it's true, then the fractal is actually a very nice indicator to determine these levels, because the supply and demand will always be sitting between these fractals. In an uptrend, between the lower fractals, in a downtrend, between the upper fractals. If you look at that on different time frames, different charts, it pans out really, really nicely. Even though I wouldn't want to trade it, I like that it makes sense. Therefore, the stops should be understood now that the stops are a very important part to keep you in the trend. So entering in a trend is not that hard. It doesn't matter if you take the fractal here as it breaks above it, or if you wait for a close above it, or if you wait for a clear close above the fractal. You can enter on all of this. Fact is, price is here right now, and you're in with profits no matter which entry you would have taken. What's much more important is where you get out. Make your choice, make your decision. It doesn't matter. Everyone likes something else. You may even change that. Just make sure that on your trading rules sheet, which should always be close to your computer, that you define it, what you want to do, and you also know why you just changed it, or why you want to change it. Thanks for watching the video. See you soon. Ask any questions if you have some.